So in this first session, we're going to look at health insurance products, and we should be able to know the concepts used in health insurance products. And then we'll also look at the different health insurance products, or what you can call plans or policies, and then identify the main features and benefits of health insurance products, and what are the problems or challenges associated with the health insurance industry, especially in our context. So when we talk about health insurance products, what we are basically talking about are the different plans that an insurance organization can offer to its clients. So the clients of health insurance organizations can be employers, okay, employers who are insuring their staff for health reasons, or you can have individuals approaching health insurance companies to to get health insurance. Okay, so we have different packages, what we can call different products. So the different products are the ones that we are going to look at. Okay, so when we talk about health insurance products, we are basically referring to the financial arrangements that provide coverage for medical expenses that are incurred by individuals or groups. Okay. What is very important is that you need to design the health insurance products to meet the needs of individuals, groups, or even the society, such that they really benefit from they benefit from health insurance. The benefits of health insurance is that they there is what we call risk pooling, where resources are brought together, and then those who fall sick, some of the resources are actually used to cover for the medical expenses of those who have fallen sick. So this prevents one from what we call out-of-pocket expenditure, or what we can call catastrophic expenditure, and therefore you generally have uh, uh, quality health care, you have improved the health outcomes, good social welfare, and economic development. These are the benefits of health insurance, and therefore it is very important that health insurance companies design health insurance products that actually meet the needs of all people in a given community. So let us remind ourselves of the key terms that we use in health insurance. The first one is premium, which is the amount that you pay every month to cover your insurance plan. Okay, so when you go and get an insurance policy, you are required to be paying a proportion of maybe your salary to that health insurance. Sometimes you can have your employer contributing part of that. Okay, so your employer contributes, and then also you also contribute, and then you cover that premium. So premium is the monthly amount that you pay to the health insurance, such that it can give you, or it can maintain your health insurance plan active. So we have what we call deductible, which is the amount you pay for covered health services before your insurance starts to become active, or starts such that the insurance companies can start to pay for your medical bills. Okay, this is very important because of the fact that when someone is insured, there is a high tendency for this person to seek, or to increase their utilization of medical services. So therefore, when you have a deductible, that is an amount that they have to pay first, or an amount that they have to pay for the medical services that they themselves use before the insurance starts to pay. That is a deductible. So when there is that amount, people will not rush to use to use the money that is on their insurance cards. Okay, so that is a deductible. So we move to what we call a co-payment, which is a fixed amount you pay for the covered health services that you have received. Okay, so this means that if for example you get malaria and then you go to a medical facility and the bill that comes out is that you're going to pay $40 for the treatment of malaria. 30% of that amount is going to come from you, and then 70% of the $40 comes from the insurance company. Okay, so that it can be a fixed amount that you really have to pay for medical services that you receive. Okay, so it may be, let us say, if the insurance if the insurance cover is say $3,000 every year. Okay, if the insurance cover is for $3,000 every year for outpatient services, they will tell you to pay $1,000, and then the other $2,000 is contributed by the insurance company. Okay, so that fixed amount that you have to pay for this services that you cover, that are covered in the insurance plan, is what we call co-payment. Okay, and then what I had earlier on explained, which is a proportion, which is basically a percentage, is what we call co-insurance. So you go to a medical center and then you receive payment of you need to make a payment of $40 for treatment of malaria, but 25% of that has to come from you before the insurance tops up. And this usually happens after the deductible. Okay, so the deductible has to come first, and then the co-insurance comes. Okay, so it could be that in the same insurance policy you have a deductible and then you have a co-insurance, or you can have a deductible and then a co-payment. Okay, something like that. Do you have any questions there? All right, just to rewind, premium is the amount that you have to pay every month for a given health insurance plan that you have. A deductible is the amount that you have to use first to cover your medical bills before the insurance starts to pay for the medical services that you receive afterwards. And then when we come to co-payment, is that if you get an insurance plan of, let us say, $4,000 every year, the insurance company will require you to pay at least $1,000. When you do that, that is a co-payment. Now, when you come to a co-insurance, is when for every medical service that you get, you pay for a given percentage. That could be 25% of the total cost of the medical services that you have received. And we have said this happens because of what we call moral hazard, which is that people who are health insured tend to use health services more, and this may not be profitable to the health insurance company, and therefore you could need them to make some payments for medical services that they first receive before the insurance starts, which is a deductible, or you have to do what we call co-insurance. So other terms, we have out-of-pocket maximum. The maximum amount of money you have to pay for covered services in a benefit period. After you reach this amount, then your insurance starts to pay 100% of the covered medical services. What you have to remember is that with the different health insurance plans or products, there are different health issues that can be covered. We can have dental services, antenatal care services. You can have a major medical expense that has happened abruptly. It can be accidents, whatever medical products that you have, medical insurance products that you have. What we mean with out-of-pocket maximum is that if you have an insurance plan for 1 year, which is basically the benefit period, there is a maximum amount of money that you have to utilize first before the insurance can start to cover 100% of the agreed medical services that you have to receive. Okay, so the benefit period is the period where your insurance plan is active. Okay, which in most cases in South Sudan, it is actually 1 year. You have an insurance plan for 1 year. It starts in May this year, it ends in May next year. Policy limit: the maximum amount your insurance plan will pay for covered medical services in a benefit period or over lifetime of the plan. Okay, so you can have, for example, you can have a medical insurance plan that gives you 5,000. That's the amount that you have to spend, and then out of that 1,000, you can have 2,000 for outpatient medical services that you may receive, and then the other 3,000 is for inpatient medical services that you could receive. So the 5,000 is basically the limit, that the maximum amount of money that you will have to use to cover your medical services or medical bills in the benefit period. Pre-existing condition is when you have a condition at the start of your application for insurance. Okay, so you go to an insurance company to get an insurance plan when you know that you have let us say hypertension, diabetes. Okay, so that condition that you have is what you call a pre-existing condition. Exclusion. This is very important when you're applying for health insurance plan. You need to know what services will not be covered or what condition will not be covered by your health insurance plan. So it is very, very important for you to actually take time in reading the terms and conditions of the health insurance plan, and especially the inclusion and exclusion part. You need to know if you are diabetic, of course, you could be interested in the health insurance covering your bill for medications for diabetes. So you need to look at that. Okay, if it is about chronic conditions that are excluded, then you need to know that when you're going for this health insurance plan, you should not have any chronic illness. And then waiting time. This is the term used to describe the period before your insurance plan starts to cover certain services. Okay, remember, you have what you call deductible. Okay, deductible is the amount of money that you have to spend first before the health insurance starts to be active. That is, before they actually start paying for your bills. So that time, you of course you will not know, because it will not be like a shop where you go say, okay, I have 5,000, I have to spend it first before I use the insurance card. With illness, you will not know when you will spend that 5,000. You may think you may not even spend it in the whole year, yet you get a medical problem tomorrow and then you spend the whole of it or even beyond that. So you really don't know. It has an element of uncertainty, and this is basically the basis of insurance, that we don't know what will happen to our health. Okay, So you get this insurance plan, and you may also not be very sure of when this health insurance plan will start to cover medical services, because perhaps you don't have any pre-existing medical condition, and it may take you time to spend that deductible before the insurance starts to come in. So that is basically the waiting time, the time before your insurance plan starts to cover medical services that have been agreed upon. And then we have what you call underwriting. Underwriting is basically the process of evaluating the risk profile of applicants and determining the premium rate and terms and conditions of the coverage. Okay, this is very important. In health insurance, a very, very important step. Okay, because health insurance works on the principle that people bring their resources together, which we call basically risk pooling of resources. Okay, which is basically pooling of the premium. Now, not all people will pay the same amount on a monthly basis, because people don't have the same health needs. You have someone who spends 1,000 every month on medical bills, and then you have someone who may spend less than $50 every month on medical expenses. Okay, so you cannot make these two people to pay the same amount of money monthly as premium. Okay, so that means that in the process when they are applying for health insurance, you have to understand their risk profile. Okay, so underwriting is a process of basically examining, evaluating, and determining the risks that people have and determining how much they will actually pay. So an underwriter is one who determines that. Then you have what you call pricing, the process of determining the premium rate based on the expected claims, expenses, and profit margin. So this is also related to underwriting. Okay, because in underwriting you determine their risks and how much they will pay. So that how much they will pay is basically the pricing, and that pricing base is based on their risk profile, their medical condition, the previous medical history, and a lot of things. But you also need to understand that this is the heart of the health insurance business, that if you don't price quite well, the sustainability of the health insurance business may collapse because you are not making enough profits. So you also need to factor that into the process of underwriting, which is basically another lecture that we shall look at shortly. So risk management is a process of identifying, measuring, controlling, and minimizing potential losses and uncertainties associated with health insurance products. And therefore, proper meticulous underwriting can be one of the strongest tools that can be used in managing risks associated with health insurance. And also remember, we talked about health insurance frauds. Okay, we talked about different tools that can be used, IT tools to assess risks and detect some fraud cases. So let us look at the details of this health insurance. What are these health insurance products or policies or plans? How can we categorize them? What you just need to know is that different countries definitely have different health insurance products or plans or policies. Okay, you have countries. Who is opening their mic? Yeah. Yeah, so we have different health insurance plans that differ based on the context of a given country. But generally, they are the following classification that we can use in describing the different health insurance products or plans. You just need to note that some products are available in certain countries but may not be available in other countries. The health insurance products that are available in the US may not be available in South Sudan, or that are available in Kenya may not be available in South Sudan. Okay. Why? Because the health system is not the same. In some countries, you have the government involved in health insurance. Like, for example, the national health insurance policy. Okay, you can have a country which has that. And then they have a country like South Sudan, which does not have what you call a national health insurance policy. Okay, so that's why we have different health insurance plans or products or policies. But generally, they differ in terms of the level of coverage, who is included and who is not included, the percentage of those who are covered and the percentage of those who are not covered. And then you have what you call network of providers. This is to say, for example, in a system like in the US, you have health service providers that form a network, or have different private entities that provide medical services coming together. So they have a network within themselves, such that you can get health insurance and the services that you have to get have to be from the network of the providers. If you go outside the network, they will not consider you. The importance of having that network is that it allows the insurance company to have control on many aspects, especially on either issues to do with fraud, issues to do with people using services that they are not supposed to be using. For example, if you want specialized medical services, you cannot go directly to a specialist before meeting a primary physician. So you need to first meet a primary physician. That is the person who will refer you to a specialized physician before you can get the specialized services. The ones that we call gatekeeping physicians or gatekeeping doctors. So that is one aspect of network of providers. And then you have the method of payment. Is it the employer? Is it the employee? Is it the government? Also, there is a great deal of difference in terms of that. And a degree of flexibility. This can be explained in different aspects. That is, if you can be able to move from one plan to the other without difficulties, in terms of making sure that all this documentation is rightly done. Okay, so for every health insurance plan that we shall be talking about, the key things are what services are covered. That is the coverage, the scope of coverage. Okay, we shall also be talking about how much you have to pay, that is cost sharing, or how much your company has to pay, and then how much your health insurance company has to pay. If you're an employee, how much is your employer going to contribute to your health insurance? And then how much are you going to contribute to your health insurance? And then how much the health insurance organization will be able to cover. Okay, eligibility. Who are those that can fit into a particular health insurance product? Okay, this is where you look at issues to do with either age, pre-existing condition, okay, and then make income group in terms of how much someone can really contribute monthly. Okay, and then the options of renewal, and then portability, which is if you move from one, if you have an insurance company, an insurance plan in South Sudan, UAP in South Sudan, if you move to Kenya. Can you access UAP health insurance services in Kenya? That is portability. And then the value added services. What more do you really have to get from the health insurance plan that you really have? So therefore, if you're going to choose a health insurance plan, you really need to look at all these features such that you can choose the health insurance plan that is suitable for you. So in this table, I illustrate some of the common examples of health insurance plans or products or policies across developing countries. So we have what we call social health insurance. This one is operated by the government. It covers citizens and residents. Basically, the money comes from you, the citizens of the country, and then that is basically taxes, okay? Taxes. And then also you can have contributions from other parties or entities. Let us say NGOs or something like that. So that is social health insurance, which we shall look at in detail in another lecture. And then we look at what we call community-based health insurance. Okay, these ones are not very common in South Sudan. I've not heard of one, but it could be very important that people like you can spearhead community-based insurance plans. So you have a community gathering and then deciding that they actually need health insurance, and then they manage that health insurance themselves. Okay, the members who are managing the health insurance are picked from within the community members. So you can have, for example, a community health insurance intervention for, let us say, women of childbearing age, such that when it comes to delivery, they pick some of that money to go and cater for the bills related to delivery. Okay, so that is community-based health insurance. And then have private insurance. You getting up one day and saying that I need to insure my health. Okay, so you go to this insurance company, and then you get it yourself, not through an employer, but you personally go there and get this from a private insurance organization. Okay, it can also be groups. Okay, you can be, like, let us say, we are clinic officers, nurses, and midwives working in this hospital. You go to one insurance organization, then they give you an insurance product that fits into your needs. Okay, so we have what you call micro health insurance. This is specifically designed for individuals of low income class, where you have a microfinance institution backing up or trying to top up the premium such that these people are actually covered in terms of health insurance. So it makes premium affordable, and coverage may actually be increased. So that is micro health insurance. So where I have micro finance organizations, okay, organizations that are trying to lend people money when where the interest rates are small. They can expand that. For example, we commonly know what you call SACCOs. So if you are in a given SACCO, that SACCO can extend health insurance services. Such that the money that you contribute to that SACCO generates interest. Okay, and part of that interest is what is used to cover for health insurance. So government-sponsored health programs. So this can also be looked at in terms of civil servants who actually seek for government resources to go for medical treatment. Okay, this can be looked at as government-sponsored health programs. In our country, that is what is existing, but also you have countries which basically provide, basically everyone is covered, or the countries that we say have achieved what you call universal health coverage. Okay, this in most cases, it is the government which have taken the lead. Okay, the government has to take the lead in ensuring that everyone is health insured. And then you have employer sponsored health plans, where your employer goes and negotiates for the health insurance plan on your behalf. Okay, and then the employer can top up the premium, or can pay a fixed amount depending on the agreed plan. So under employer sponsored health plans, you will also have multiple plans under that. Okay, so you need to decide. If you are the employer, you need to decide which health insurance product or policy is good for your employees. And then you have mandatory health insurance, where everyone by law is required to contribute to the health insurance fund. Okay, this one also basically needs government intervention. Okay, you cannot, it's very difficult to have mandatory health insurance when the government is not the one that is taking the lead. Why? Because the government has what you can term as the coercive forces, the forces that can make people to comply by the rules and regulations. And then voluntary health insurance, this is where you actually choose as an individual or family. You have the liberty to choose which health insurance is good for you. Okay, so it is voluntary. No one actually forces you. You plan and then choose the health insurance on your own. That means, therefore, the opposite of mandatory health insurance is health. Mandatory health insurance is voluntary health insurance. Rural health insurance is basically almost similar to what we had described in community health insurance initiatives. Okay, one, you need to understand that in most cases, rural communities are actually low-income earners, and therefore, if you're going to market a health insurance plan to them, you need to consider the fact that the premium has to be low. And then we have what we call catastrophic health insurance. This is an insurance plan that covers any medical expenses that can result from a health-related event that has extreme implications on the costs. Okay, so that's why we are calling it catastrophic health insurance. Okay, so that means that for this insurance, there should be a limit for which this insurance can actually be activated, minimum and the limit. It's very important. So if you have known all these health insurance products, one of your roles as a health insurance specialist, whatever roles that you can take under health insurance, you need to be able to market them. So how do you do the marketing? What skills do you really need? One, you need to understand that you need to be very effective at communication, negotiation, presentation, problem solving. You need to be aware of the market, the potential market, create awareness, and understand the customer behaviors, their needs and wants. And therefore, also these health insurance products should be marketed in an ethical way, in that you really comply with the regulations of the specific territory you're working in. So what are the things really happening, and what challenges are there in health insurance? On a daily basis, the cost of healthcare is increasing every year. That is a problem that is happening. And this therefore actually means that the premium also has to increase. And if you increase the premium, you're going to create inequity where people who are poor are not accessing um, insurance coverage. Okay, and then you also have customers changing preferences and expectations about health insurance products. Okay, that means that you really need to monitor the trends in terms of consumer behavior, expectation, and preferences. If you don't do that, you create health insurance products that the customers will not take up. Okay, the use of technology is very rapid, and you really need to embrace it such that you can keep up with the competition. Insurance as a business itself has risks, but of course, the risks can also be looked at as an opportunity for growth. Okay, and it's also very, very important that the health insurance markets are actually regulated. This is where the government comes in. Okay, so that marks the end of our presentation. If you have any questions, you can ask.